We are back on Taking Care of Business on Koerner Radio, News Talk, 1180, 1230 KGEO, 1410 KERI, and now in Albuquerque, New Mexico on 1000 KKIM, as well as 3 times a week on the Internet nationwide through knookmedia.com. Our guest by phone, Kaya Bromley, who wrote an excellent book called The Employer's Guide to Obamacare.
You know, it's interesting, Marty. I got an email from Kathy back in New York the other day with Benestream.
Yes.
And she said one of her brokers in D.C. heard our show.
I heard that.
That was interesting.
I saw that. Yeah.
But back to Kaya. Kaya, can you talk a little bit about the individual mandate and the employer mandate?
Absolutely. So the individual mandate is the part of the law that requires all U.S. citizens and people working in the United States to have health insurance by January 1st. And if they don't have health insurance, they're going to pay a penalty. Now, I call these penalties, they're actually excise taxes. Now, the individual penalty will only be paid out of a tax return. So if someone does not file a tax return, they're not going to be assessed. They're not going to have to pay that penalty. The confusing thing with the individual mandate is, with regard to the exchanges, when they can go on the exchange and they can get their subsidies. If they qualify for a subsidy, but then later their situation changes, their income goes up, they have to pay that subsidy or tax credit back, and that's something that not a lot of people are talking about. And then the employer mandate is the part of the law that requires employers to offer health insurance to their full-time employees or pay a penalty. Now, again, I say the word penalty, but it's actually an excise tax. And it's not, we say it's an employer mandate that they have to, but they really don't. It's in some employers' best interest not to pay the penalty or not to offer the insurance and pay the penalty. So it is an option. They can choose to comply with the law, or they can choose to strategically count their employees and count what their penalty would be and decide that that's cheaper than offering insurance.
Now, in 2015, it's for groups of 100 plus, and then in 2016, it's for groups of 50 plus. Is that correct?
That's correct.
And the first year, they only have to offer the benefits to, 70% of their population versus 95% after that?
That's correct, too.
Wow.
Boy, I can't believe it.
You must have learned that from my book.
Yeah, I mean, he's 2 for 2. That's pretty good for Clay.
I know, that's good.
Well, I'll tell you, all this information I'm talking about now is in this book. And as I said, this is the best book that I have found on Obamacare rules, regulations, compliance, and requirements.
And Kay,
I didn't pay him to say that.
No.
Yeah, and that says a lot because we've had numerous people on with their books talking about the subject. I've got a question for you, Kay. Now, you're an attorney and a business strategist, and as far as the legal end of it, there's been a lot of challenges to Obamacare. Where are they in the system right now?
So, yeah, I agree with you. There's a lot of challenges, and we're not going to see the end of it. They're going to keep trying to challenge it. At the end of the day, if it ever was to go to the Supreme Court, which they'll try again, those of us in the legal community who are watching this very closely, we can never say anything for an absolute certainty, but it's not likely that they're going to do something to completely overturn the bill. They had the chance to do that, and they chose not to. So now they may change things, and I think that everyone should be prepared for it to change, but I don't see it being completely overturned.
Well, is it the individual mandate that may make this thing fall apart?
No, on the contrary, I think the individual mandate is not the thing that would make it fall apart, because that's the one that was already decided at the Supreme Court level.
By Judge Roberts, okay.
Yeah, the challenges that they're making now are like there was the one that was a couple months ago in the U.S., or the Washington, D.C. district, the district court, and that one was about whether an individual who was applying for insurance on a state exchange could get a subsidy or not, and that was an argument about the way that the statute was drafted. Now, right now, what they would need to go to the Supreme Court was they would need 2 different jurisdictions to disagree. And right now we do, in fact, have 2 districts that disagree, but the Obama administration is probably going to appeal in the decision that disagreed. And that court is stacked with judges that were appointed by the Democratic Party. So we anticipate that it's likely that they're going to overturn that decision and all the districts will be in agreement again.
We're having a conversation with Kaya Bromley, author of a great new book, The Employer's Guide to Obamacare.
Kaya, can you explain minimum essential coverage, what that is, and why an employer needs to offer that?
Yes. Minimum essential coverage is simply the offer of coverage. And the definition of it is that the definition contemplates how it was offered. So Medicaid, employer-sponsored. There's nothing in the definition of minimum essential coverage of what has to be covered. It just has to be an offer of coverage. The reason that this is so critical for employers is that if they don't offer minimum essential coverage, they can be subject to a penalty of $2,000 for every full-time employee, and that includes full-time employees who are on Medicaid, who are receiving other insurance. It doesn't matter. It's a straight number trigger. So you have one employee that goes to the exchange, and you have to offer insurance to everybody, or pay the penalty for everybody. When Clay, you and I were talking a little bit about different strategies. One of the most important strategies, and easiest strategies, by the way, is for employers to offer a minimum essential plan across the board. Some are even doing it with their part-time employees because they're variable and part-time, because there are times when someone's going to be full-time and they don't realize it because they did their measurement method wrong. So that is like an insurance policy offering the minimum essential coverage to everybody just to avoid that penalty.
Now, that's only part one. There's a second part to this. They also have to cover the minimum value, have a minimum value policy for everything that the essential policy doesn't cover, I believe.
Yes. So part two of that is we call that penalty B, and that is $3,000 per employee. If each employee that goes to the exchange, you pay $3,000 for them if they qualify for a tax credit or a subsidy. If the insurance that you're offering is not affordable and minimum value. Affordable means that the employee can pay no more than 9.5% of their household income toward the contribution, and minimum value is an actuarial value. It means that it has to meet a 60% actuarial value. Is it
9.5% of just the Part 2 or 9.5% of the whole program?
No, so in order to satisfy, so you're saying Part 2, you're meaning if there's
the minimum value,
a minimum value plan,
right?
It would have to be 9.5% of that minimum value plan.
So, assuming the employer pays for the essential benefits. Is that correct?
Well, that depends. Now, we're talking about something different here when we're talking about essential health benefits. So only small groups are required to offer essential health benefits. Large groups and self-insured groups are not required to. However, in all of the actuarial calculations and to qualify using the calculators that are put out by the IRS and the Department of Labor, they do take into account essential health benefits, but it's not something that's required.
And I think the other part of this that people don't understand is an employee can go and get a subsidy even if they're making up to $94,200 a year. And if they do get that subsidy, then the employer can be subject to a $3,000 penalty for every individual that gets a subsidy. Is that correct?
Yeah, you're making a really great point here, because a lot of employers think that they have a great strategy by only offering the MEC plan, we call it the skinny plan.
Right.
And then they're just going to roll the dice because they don't think anyone's going to go to the exchange and get the subsidy. Your point is well taken that the subsidies are very, very generous. And what you were referring to is that an employee can get a subsidy if they make up to 400% of the federal poverty level. And they can make a lot of money and still qualify for a subsidy. The other thing, too, the other problem with that strategy is their interests are directly opposite of the federal government. The federal government is doing everything that they can to recruit people into the exchanges because they need young, healthy people into the exchanges. So having a strategy that counts on people not going in there when many of them can get free coverage or very inexpensive coverage is a really bad strategy.
Kay, one question before we go to the break. You're not really necessarily pro or con Obamacare. You're just looking at the facts involved, right?
Right, exactly. So if you were in my backyard and we were sharing a glass of wine, you'd probably hear my real opinion. but overall, I found that it doesn't do anybody any good. I'm also a business owner. My husband and I own some restaurants in Michigan with some partners. And I was general counsel for a company for a pizza franchise, Marco's Pizza, for 6 years. So I look at it from so many different perspectives that just sitting there complaining or taking a policy argument doesn't help anything. So, okay. Yeah, my whole approach with my clients is whether you agree with it or disagree with it, that's irrelevant. Let's get it done.
Exactly. Can we hold you a little longer after the break? For another
Absolutely.
Okay, great. We'll be back in a moment on Taking Care of Business on Koerner Radio News Talk 1180.